Non-current liabilities. Essentially, in this reading, we are talking about non-current liabilities. So we are on the right side of the balance sheet. Within non-current liabilities, we will look at some of the most common non-current or long-term liabilities, and those include bonds payable. Sometimes bonds payable are also referred to as notes payable, payables that have a maturity of less than 5 years. In some countries, less than 10 years. Bonds tend to be longer term, but the accounting and analysis is essentially the same. So in this reading, the term bonds payable is used. Then we'll talk about leases, the different kinds of leases. Within leases, we can have operating leases, which are considered off balance sheet, and finance leases, which need to be shown on the balance sheet. Then a very brief segment on pensions and other post-employment benefits. This particular topic is covered in a lot of detail at level 2. At level 1, we will just scratch the surface. And then finally, evaluating solvency. This essentially is some of the ratios that allow us to evaluate the solvency of a company. You have seen these ratios before, but as has happened in almost every reading, the last part of the reading deals with the relevant ratios associated with that particular topic. Okay, first, let's just understand the basic concept behind a bond and then a bond payable. Bonds are contractual promises made by a company to pay cash in the future to its lenders or bondholders. So the term lender and bondholder will be used interchangeably. Sometimes we also call them investors. So investors, lenders, bondholders all generally mean the same thing. In exchange for receiving cash in the present, terms of the bond contract are contained in a document called an indenture. Now here is a graphic that will explain the concept. You have this company over here which needs to raise funds. Companies can raise funds through equity markets or through bond markets. When a company issues a bond, essentially it is borrowing money. So what the company does is it issues a bond. A bond is essentially a contract. It's a piece of paper. It's a promise. So the bond is issued, and this person represents an investor or a set of investors. When this investor essentially buys the bond and gives money to the company, he needs to do an analysis. He needs to say, how much money will I give to the company? And the way it works is as follows. With the bond, the company is making a certain promise that in the future I will pay you this much. I'll give you a very simple example here, and then on the next few slides we'll make it a little more complicated. Let's say that this bond right now is a bond where the company is making a promise that at the end of 1 year, the company will pay the investor $110. Okay, so the investor knows this. Now, the question is, how much money should the investor pay the company at time 0 when the bond is being issued? To come up with that amount, the investor needs to think about how much risk is he taking by investing in this bond. And then he needs to come up with the return that he requires. Given the risk that he is taking, there is a certain return that he requires. What is that return? This topic was covered briefly in quantitative methods in the reading on time value of money, and it will be covered in a lot more detail when we do fixed income later. Right now, we'll say that the investor just comes up with the 10% number, that based on the risks involved, he requires a return of 10%. So if the investor is getting 110 after 1 year and he requires a return of 10%, how much will he pay the company today? He will pay the company 100. So essentially, if he pays the company 100 today and he is getting 110 after 1 year, then effectively the interest rate is 10%. So this 10% is called the effective interest rate. It is also called the market rate of interest at issuance, at the issuance of the bond. So you remember these two terms, they are very important. In this particular reading, we are focused on how the company shows the bond on its financial statements at issuance and then over the life of the bond. When we do fixed income securities later, then we will take the perspective of the investor. Okay, now let's get into a little more detail. On the previous slide, I gave you a very simple example where the company said that it will pay 110 after 1 year. Most bonds are a little more complicated than that, and as you'll see later, there are a whole range of bonds with different terms and conditions. What we are going to look at in this reading is a very simple straight bond where the following information is given. A company issues a bond which has a certain face value. The face value is also called the par value. Let's say that in this particular case, that number is 100. And this information is all written on that contract, the bond contract. So the face value or par value, which are synonymous, equals 100. Issue date is 1 January 2011. Maturity date is 3 years later. So the maturity for this bond is 3 years. The coupon rate is 10% paid annually. Through this information, the company is promising a certain cash flow. Now, what is that cash flow? This is just the way bonds work. The bond has a 3-year maturity, 0, 1, 2, 3. The cash flow at the end of year 1 is 10. Where does this 10 come from? You take the 10% coupon rate, multiply that 10% by the par value, and you come up with the coupon payment. This is the first payment the company will make to the investor. Then 10 again, this is the second coupon payment, and then 10 at the end of year 3, which is the third coupon payment, and then the face value or par value of 100 is paid at the end or at the maturity of the bond. Now, the bond contract has several other details about the issuer's obligations. We will talk about this later. Now, what has been defined over here? What has been defined is the cash flow that the company will give, or the money that the company will give to the investor. The question now is, how much will the investor pay for this bond? If the investor's required rate of return is 10%, then what do we do? Or what does the investor do? How much will he pay? What he will say is that I have a required return of 10%. Let me discount all these numbers back using the 10% rate, and whatever number I come up with, that's the number that I will pay the company. If you take out your financial calculators, and here it should be fairly obvious, but I'll make you do this anyway. You plug in n is equal to 3. The interest rate is equal to 10. That's for the 10%. In this particular case, the payment is also 10. Where is this 10 coming from? Is this the coupon rate or is this the required rate? The 10% that you are plugging into the calculator is the required rate. It's the rate that you are requiring as an investor. So this is important. In this particular example, the coupon rate and the required rate is the same, but that is not necessarily always the case. Payment of 10, these are the coupon payments. And then you plug in future value is equal to 100. That is this number over here. And all this should be familiar from reading 5, time value of money. And you then compute the present value. The present value that you should get is 100. Minus 100 on your calculator, but essentially that is the amount that the investor will pay. Now, obviously, you can hopefully see this from the numbers. If you pay 100 now and you are getting 10, 10, 10 at the end of every year for 3 years, plus your money back, you are getting a 10% return. Okay, so in this particular case, you have paid the company 100 and then you are effectively getting a 10% return. How is the issuance reflected in the financial statements? What do you do on the balance sheet for the company now? So from a company perspective, what happens on the balance sheet? The company receives cash. So assuming here that there are no issuance costs, we'll talk about issuance costs later. The cash goes up by how much? By 100. and the bond payable also goes up by 100. So that's what's happening on the balance sheet initially. What about on the cash flow side? So whenever we ask what's happening on the cash flow, you are getting money, but the real question is how is that categorized? Okay, so money is coming in, so it doesn't take a genius to figure out that money is coming in. But what a CFA level 1 candidate needs to figure out is what's the category. So this is a cash flow from financing. You have issued a bond. The issue is shown as a financing inflow. All right. What about the income statement? Initially, nothing is put on the income statement because this is at time 0. You have issued the bond. So initially, there is no expense or revenue recognized. That we will see later. Now, notice in this particular case, when the coupon rate is equal to the effective interest rate. What's the effective interest rate? It's 10%. That is also the market interest rate when the bond is issued. When those two numbers are the same, then the money raised is equal to the par value. So then the bond is issued at face value or the bond is issued at par. All right, now let's look at another scenario where the coupon rate is less than the effective interest rate. Same bond, so this information is exactly the same as what you saw on the previous slide. When the bond is issued, investors require a return of 11%. Why? Let's say that investors now perceive the company to be more risky. If an investor perceives the company to be more risky, then the investor will require a higher return. In this case, the return required is higher than the coupon rate that the investor will get. Okay, so the first question now is, how much will the investor pay? Or the other side is, how much will the company receive when it issues the bond? So here again, the company is promising a certain cash flow, and the cash flow is the same as what we saw on the previous slide. 10, 10, 10. These are the coupon payments plus the 100 par value at maturity. So what is the present value of these numbers if we discount at 11%? Notice that we need to discount at the market rate of interest when the bond is issued. If you plug your numbers into the calculator, you should have n is equal to 3. Interest rate now is 11%. And then your payment is equal to 10, future value is 100, and if you compute your present value, what you should get is 97.56. Again, the calculator will give a negative number, but in the reading on time value of money, we talked about the plus minus, so I won't repeat that point. So the point is that the company raises 97.56. What are the entries made on the accounting side? The cash goes up by this amount, and the bond payable also goes up by the same amount. What about on the cash flow statement? This amount is shown as a cash flow from financing. It's obviously a inflow. All right. I'll make one high-level remark before moving to the next case. When the coupon rate is less than the effective interest rate, which is the scenario over here, the coupon rate is 10%. The effective interest rate, this is the rate that investors demand when the bond is issued. That is 11%. When this happens, the bond is issued at a discount. And the way you can think of it is, if you are an investor, you are paying 97.56 over here, but you are getting 10, 10, 10 and 100 back. So clearly this shows that you are getting a return more than 10%. And why do we need to do it this way? Why not just give you a 11% return? Why don't you just pay 100 and get a 11% return? The answer is The bond defines the cash flow that the company will give you. So that bond has defined this cash flow. That is fixed in this particular case. But you demand a higher return than 10%. So to get that higher return, you just pay less. When I say pay less, less than what? Less than par value. All right, so remember this relationship. I can almost guarantee that something like this will be tested on the exam. Okay, next scenario. Now the coupon rate is greater than the effective interest rate. So the bond is the same. The cash flow again will be the same. The difference now is that investors require a 9% return. The situation here is that investors evaluate the company and the bond issue and figure out that this company is actually very good and they are willing to live with a return that's less than 10%. When this happens, then we say that the bond is a premium bond because investors are now going to pay more than par value for this particular bond. So the calculation is the same as what we've seen before. N is 3. The interest rate now will be 9%. So you plug in 9 into your calculator. The payment is 10. The future value is 100. And you compute PV, you should get. So the present value is 102.53. Again, I will skip the details. This essentially is what you receive or the company receives as cash. So the entry on the balance sheet is cash goes up by this amount, bond payable goes up by this amount, and this is cash flow from financing. And as we've seen on the previous slides, coupon rate in this particular case is 10%. If that is greater than the effective interest rate or the market rate when the bond is issued, then we say that the bond is issued at a premium. All right, what we will do on this slide now is say that, okay, the bond has been issued. Over the 3 years, how do we account for the bond? What do we show on the balance sheet? What do we show on the income statement? What do we show on the cash flow statement? It's the same bond that we are talking about. Is this the discount bond or the premium bond? You can't just look at the bond and answer that question. You also need to know that when the bond was issued, what was the market rate? If the market rate was 11%, then was this a par, premium or discount bond? It was a discount bond. So we now need to look at the interest payments, interest expense, and what is the reported bond value at the end of every period, and then how are the numbers reflected in the financial statements. I have done this exercise in Excel, which I will post on our Google group, but here are the numbers. The bond was issued on 1st January 2011. The carrying value at the start of the year was 97.56. This is the number that we just calculated. The interest expense is 10.73. Where does this come from? The interest expense is always the interest rate times the liability at the start of the period. What is the bond liability at the start of the period? The bond liability at the start of the period is 97.56. You multiply this by 11% and you will get 10.73. So that is the interest expense during the year for the company. But how much money does the company actually pay? The company is paying 10. Amortization of discount. What this means is that you compare the interest expense, which is different from the interest payment. What is the interest payment? It is the coupon payment that you need to make. The difference is 0.73. Now this 0.73 is added to 97.56 and you have a carrying amount. This is the carrying amount of what? It is the carrying amount of the bond liability. The bond liability at the end of the year is 98.29. That is carried forward to the start of 2012. Again, where is this 10.81 coming from? This is 11% of this number. The interest payment again is the same. 0.81 is the amortization of discount. So this is 10.81 minus 10. Carrying amount is this, which is carried forward. Follow the same exercise. And the carrying amount at the end is 100. Why are we doing this? As a company, after 3 years, how much does the company need to give? It needs to give that par value back. So ultimately the obligation or the liability at the end of year 3 is going to be 100. But the company has shown the value as 97.56 at the start or at the time the bond is issued. So the process that we are following here, this amortization process, is taking the bond value from 97.56 at the start of year 1 to 100 at the end of year 3, which is when the bond matures. Okay, now what's the balance sheet treatment? Essentially, the bond is recorded at 97.56 at the start of year 1, and then at the end of year 1, how much is the value on the balance sheet? The amortized cost is 98.29, and then end of year 2, the liability is this. End of year 3, the liability is 100 because that's the amount the company has to pay at the end. So that's the balance sheet treatment. What about the income statement treatment? On the income statement, you show the interest expense. Is this the same as the actual money that is paid? It is not the same. But on the income statement, you need to reflect the fact that you as a company are paying 11%. And then what about the cash flow? What is the actual cash flow happening? The actual cash flow is 10. Now where does the 10 go? If you are following US GAAP, then the interest paid is part of CFO. That is just the rule under US GAAP. What does IFRS say? IFRS says that you can either put it in CFO or CFF. Okay, so for simplicity, we'll now just go with CFO, but IFRS does give you the flexibility. All right, now here is an exercise for you to do. We now look at a bond which is issued at a premium because the market rate is 9%. We have already talked about the carrying amount, so you need to do this, and I will post the Excel file on our Google group. So the initial carrying amount is 102.53. Interest expense 9.23 is based on 9%, which is coming from here, of the initial carrying amount. Interest payment is 10. Amortization of premium 0.77, that's 10 minus this number, and then the carrying amount 101.76, that is the initial carrying amount minus 0.77. And you can do the same for the remaining years. We've already talked about the treatment on the financial statements, and I will post the Excel file on our Google group. Here is another interesting question that I will touch on here, and then you will see this in detail when we do fixed income. One sort of a bond is called a zero coupon bond, where no coupon payment is made. There, obviously, when the company issues a bond, the bond would have to be issued at a discount. So, in a sense, it is a discount bond. Why? What is the definition of a discount bond? This is where the market rate of interest, let's say the market rate of interest is 10%, is greater than the coupon rate. What's the coupon rate for a zero coupon bond? It's 0%. So you can simply treat this like a discount bond. So what would the carrying amount be? Given that we have a par value of 100, when will the investor receive this 100? the investor will receive the 100 at the end of 3 years. So if the investor is requiring a return of 10%, how much will the investor pay the company at time 0? So in your calculator, you plug in N is 3, payment is 0, interest rate is 10, FV is 100, and you should get a present value of 75.13. That's how much the company gets. So this is what's shown initially on the balance sheet. Then the interest expense is 10% of 75.13. So that would be 7.5. How much is the interest payment? The interest payment is actually 0 because nothing or no payment is being made. So now the amortization of discount is the difference of the two, which is 7.5, and the carrying amount at the end would be 75.13 plus 7.5. So this value will go up. And when we keep doing this for 3 years, how much should we have at the end of 3 years? At the end, you should have 100. Now, the important point here is that you keep showing an expense on the income statement, but are there any cash flows that are happening over the life of the bond? No, you just have the initial cash flow from the company perspective where the money is received. After that, there are no cash flows. So CFO will look good because no payments are being made. Income statement will actually reflect the expense. Now again, I'll put this in the Excel file that I post on our group. So far, I have ignored issuance costs. They tend to be small, especially for bonds, but when a bond is issued, obviously a company has to pay some money. When a bond is issued, it is issued through an underwriter, and there will be underwriting costs. We don't need to go into the details, but just recognize that there are some costs. Those costs are called issuance costs. How do we treat them? How do we account for them? Under US GAAP, issuance costs are shown as an asset. So for example, let's say that a company issues a bond with a par value of 100. Let's say it is also issued at par. And let's say that the issuance costs are 4 for a $100 bond. This 4 will be shown as an asset on the balance sheet. It's money that is spent. So effectively, what is the company doing? It is capitalizing that cost. And then what do you think will happen to this cost? It is going to be amortized over the life of the bond. If the bond is a 3-year bond, then over 3 years, this 4 will be amortized down to 0. IFRS says that the issuance cost should reduce the carrying value of the debt. So effectively what IFRS is doing is netting, where if I go with the same example, let's say that the company issues the bond at par. So how much will the company get when it issues a bond with $100 par value? It will get 100. But then it needs to pay 4 to the underwriter or the entire issuance cost. So effectively, how much money does the company get? So the cash will go up by 96 and the bond payable will also go up by 96. So the issuance cost is just built in. This way we don't have a separate element that's created on the balance sheet. Okay, so it's a subtle point. I don't think it's overly testable, but there is a question at the end of the reading on this, so it's important for you to know. Okay, now some general points. The effective interest rate does not change during the life of the bond. The point here is, let's say that you are the investor and I am the company, so I issue a bond. When I issued the bond, the interest rate was 10%, so essentially I issued a par value bond. Now after that, the rate in the market will keep changing, but as far as I'm concerned, the company is concerned, I'm going to record as if the rate is 10%. So I use the effective interest rate, which is what the market rate was when I issued the bond. That doesn't change. Another point is that the book value of a bond rises for a discount bond and falls for a premium bond. And hopefully you saw this. If we look at a timeline, and let's say that this value here represents par, if I issue a discount bond, will I issue it at a price of 100, more than 100, less than 100? It will be less than 100. Let's just say for simplicity that I issue the bond at 96. This is a discount bond. And this is a 3-year bond. So what will happen over a 3-year period? The value of the bond on my books, I being the company, will rise to 100. Why? Because I am amortizing, and at the end of 3 years, what's my liability? It is 100. So on my books, I will slowly increase the value so that ultimately the payable is 100. What about a premium bond? So if a bond had been issued at 104, then what happens to the book value over the 3 years? Then it would decrease. Okay. Now, here is another point that some people get confused about. We just talked about amortizing the discount. Okay, so we use the term amortize. In the previous reading on long-lived assets, there we also used the term depreciation and amortization. So when we used amortize in the previous reading on long-lived assets, and when we use the term amortize over here, is it the same thing or is it different? There is actually a similarity. What is the similarity? A lot of people don't think about it, but I will help you through this. What do you do when you amortize or you depreciate? You have an asset, for example. Let's take a very simple example. Initial value of the asset is, say, 100. And you expect that after 9 years, the value of the asset will be down to 10. So if this is a tangible asset, you say depreciation. If it is an intangible asset, you say amortize. Let us just say that this is an intangible asset. What does amortization mean? It means that you are going through a process to reduce the book value down to 10, which is what you expect the book value to be ultimately. Now notice that this was done for an asset. What are we doing through amortization with a bond? In a sense, we are doing the same thing. If a bond was initially at 104 and after 3 years the expected value is 100, through amortization we are just adjusting the book value of that bond liability so that ultimately it is down to 100, which is what you expect the liability to be after 3 years. So in a sense, amortization has the same meaning in both cases, on the asset side and the liability side. We are just making changes to the value on the books so that ultimately the value on the books represents what you expect the final liability to be. All right, and then finally, the effective interest rate method versus straight line method. I don't think this is overly testable, but everything that we've talked about so far is based on the effective interest rate method. So we have said that the effective interest rate is the rate that was in effect when the bond was issued, and then all our subsequent amortization and interest expense is calculated based on that effective interest rate. Now, another method for amortization would be a straight line method, which is allowed under US GAAP, where you say that, okay, the bond is initially at 104, I will bring the value down to 100 using a straight line method, just like we do with straight line depreciation. So recognize that this method exists and recognize that it would simply be an equal amortization over the period. With the effective interest rate method, the amortization is not equal, and you can see that from the examples that we have discussed. But if you are not told what method to use, the default in general is to use the effective interest rate method. I want you to do this question now. So the numbers you look at here, the coupon rate is 8.5%. which is more than the effective interest rate, and that is the rate which was in effect when the bond was issued. When this happens, then you have a premium bond. This is a very simple question, and it's a sort of question that you might expect on the exam. This other number, the market rate of interest today is 9%. That is irrelevant in the context of this question. Okay, try this one now. So here is how you look at this problem. We have recognized that we have a premium bond, so it will be issued at a price above par. I have just picked some numbers here. It doesn't really matter, but it helps you solve a problem when you are working with simple numbers. Say 100 is the par value. Let's say that when the bond was issued, it was issued at a premium, say at 104. At the end of 5 years, the bond will be back down to par. That means that 2 years into the life of the bond, or any time actually between issuance and maturity, the book value will be above par. Current market rates and fair value reporting option. All the discussion so far has focused on reporting bonds at amortized historical cost. This method reflects the market rate at the time the bond was issued. What's the other term for this? It is the effective interest rate. So all the discussion has focused on using that effective interest rate, having an initial historical cost and amortizing so that ultimately the value of the bond is equal to par. Now in between, and when I say in between, I mean in between the time the bond is issued and the bond matures, the interest rates in the market, called the market interest rates, they are up and down. And as you will see in a lot of detail when we do fixed income, the value of a bond in the market moves up and down with interest rates. Very simplistically, when interest rates move up, then the bond price, which is the present value of the future cash flows, comes down. And when rates go down, the price goes up. What accounting standards have done recently is that they allow companies to mark to market and report at fair value. So this is called fair value reporting option, but most companies choose to show the bond, especially if it is held to maturity, at amortized cost. All right. When the market rates change, the bond's fair value diverges from reported value. So if the reported value is based on historical cost and then amortization, then obviously changes in interest rate will mean that the historical cost and amortization, the reported value is different from market value. Okay. So as I mentioned, companies have been given the option to report financial liabilities at fair value. So just recognize that that option exists. And how does this impact you as an analyst? When you are looking at the liabilities section of the balance sheet, you need to look at the footnotes where obviously it will have to be disclosed whether the liability is being disclosed at amortized cost or fair value. Derecognition of debt. What does this mean? It's a fancy term, but effectively it means that a company has issued a bond. Now, when a company issues a bond, either the bond can remain issued and then at maturity the company pays off the par value. So that's one scenario. Or effectively the company can pay off the investor and retire the debt. So that's called redeeming the bond. And later on you will look at different ways of redeeming a bond. But essentially the company is paying off the investor before the bond matures. Once bonds are issued, a company may leave the bond outstanding until maturity or redeem the bond before maturity. When a company redeems the bond before maturity, there is a good chance that the amount of money that the company is paying to redeem the bond is different from the book value of the bond. How is that accounted for? There will be a gain or a loss. Obviously, if the company is paying more than the book value, then that should be a loss. If the company is paying less than the book value, then that would be a gain. Where will that gain or loss be shown? It will be shown on the income statement. But first, let's make sure we understand how to do the basic calculation. The gain is equal to the redemption price minus the book value of the liability at reacquisition date. So let's say that the redemption price is 1,020,000. The book value is this. Is this a gain or a loss? It is a loss because the amount that is being paid is more than the book value. So more cash is going out. So in this particular case, the loss is 30,000. The gain or loss from extinguishing debt is reported in the income statement in a separate line item where the amount is material. So if the amount is almost insignificant, then you don't need to show it as a separate line item. Dealing with bond issuance costs. Do you remember we talked earlier about the fact that when a bond is issued, there are going to be certain costs, issuance costs. What did US GAAP say? US GAAP said that when you issue a bond, the issuance cost has to be capitalized and then amortized over the life of the bond. So if a bond has a 5-year life and then after 3 years it has been redeemed, will there be some issuance cost on the balance sheet?
Yes.
It will be. So the unamortized bond issuance cost must be written off and then included as a gain or loss in the calculation. Obviously, it would be a loss if you are writing off the asset. What about IFRS? There is no write-off because the issuance cost is included in the book value of the bond liability. We are coming to the end of the segment on bonds. Debt covenants, again we'll talk about these briefly here and then in more detail in fixed income. Debt covenants are restrictions on the issuer that protect the bond holder's interest. So if I am a company, I've issued a bond, obviously I have borrowed money from you. So there need to be some restrictions on me or some rules that I need to follow in order to make you comfortable, the investor comfortable. These restrictions reduce default risk, the risk of me, the company, defaulting. And if the risk of me defaulting is less, then that also reduces my interest cost. Because if my risk of default is lower, then I can borrow money at a lower interest rate. When we talk about debt covenants, very broadly speaking, we can either have affirmative covenants or negative covenants. And simplistically, affirmative covenants are covenants where I, the company or the issuer, say that I will do so and so. So I will pay my coupon payments on time. I will make my payments. I will pay my taxes and so on. So all the places where the covenant says that the company will do so and so, they are called affirmative. The covenants where a company is saying that it will not do so and so. For example, a company will not issue new debt. Those are examples of negative covenants. Now, both positive and negative covenants are there for the benefit of the investor. Technical default, this is a term used where one of the covenants has been violated. So, for example, a company says that it will not issue new debt, but it issues new debt. Even though the payments to the investor are being made, but one of the covenants has been violated. That is called a technical default. Presentation and disclosure of long-term debt, you can read this, but I will give you the basic points, and most of this you know already. When you have long-term debt, the current portion of the long-term debt, which is due within 1 year, is shown under current liabilities. The rest is typically shown as a single line item under non-current liabilities. And then if you look at the footnotes and disclosures, there will be a tremendous amount of information about all the long-term debt. And then you can also find additional information in the management discussion and analysis about a company's capital resources, which includes debt financing, and off-balance sheet financing. Off-balance sheet financing is where a company raises money but doesn't show it on the balance sheet, and that happens through leases, and specifically operating leases. That is what we will discuss next.